there's the same kind of rising risk in equity markets, in bond markets, in private equity, in private credit. There are all kinds of risks. We've seen the highest number of companies going bankrupt in the first half of this year that we've seen in a long time, and that's kind of gone unnoticed. And so that there are all kinds of data points that suggest that there is a real reason to be cautious right now. And if the debt ceiling isn't the trigger, then we're going to turn our focus back to a pivot and whether the Fed are going to continue to hike and break things. So there's just this kind of endless conveyor belt of things to not necessarily worry about, but be cautious about and understand that they could have a negative effect on markets.
On today's episode of the What the Finance podcast, I have the pleasure of welcoming back Grant Williams, who doesn't need any introduction. So, Grant, thank you so much for joining the podcast today.
Hi, mate. Great to be back. Nice to see you again. How you doing? All right?
Yeah, I'm going well, thanks. But a lot has happened since our last conversation. I think it was last October, and it's crazy to think how many things can break and how high the market can go and the volatility. It's been really interesting. So, I guess from your perspective, what have you really been watching or that's happened during that period? Because we've seen bank crises, we've seen geopolitical risks and issues, etc. What have you been watching?
Well, I think, and you're right. When you say so much has happened since the last time we spoke, you and I could have spoke 3 days ago, and you could say the same thing. It's just things are moving very quickly, and there's an awful lot going on, as you say. So I think, when you talk about all these various crises, I think for me the main thing to watch and understand is that risk is increasing. For the very reasons that you just laid out. We have had banking crises, we have had rate scares, we have had inflation spikes, we have had debt ceiling worries. There's an awful lot of things that are kind of floating around that could upset markets. And look, markets climb the wall of worry, as the old saying goes. And so they've been pretty steady. In fact, in the US, you've seen some pretty good headline performance in markets already this year. Although if you kind of take away the big stocks, it's a lot less convincing under the surface. But not so many people dig under the surface and look at the broader market. They look at the headline index and go, everything's great. That's decidedly not the case. So, as we sit here today, what is it, May 24th, I think, we're bumping up the debt ceiling, and that's the thing that's now going to come into focus, because I think everybody assumes it'll get fixed because it always has, and the strong likelihood is that it will get fixed. But again, there is some jeopardy here. There is a chance that they could screw this up, because ultimately there are people involved in trying to make these decisions, and those people come from polar opposite political viewpoints. And in the current climate, particularly with presidential elections coming into view and candidates starting to announce their runs, the broad problem is in the people's mind now. If you are the Democratic candidate or you are the Republican candidate, or even if you are a high-ranking, senior, visible member of either party, and you are seen to cave into the other side, it's not seen as a good thing anymore. It's not seen as a good thing to be bipartisan and work across the aisle. It's everyone's drawn a line in the sand. Everyone's taken their side, and if you deal with them, whichever side you come from, you're a turncoat and a traitor. So that's going to make it much harder to get a deal done, because someone's going to have to come out and look like they've conceded. And that won't play very well. And everybody's got their own personal dog in this hunt, and they don't want to be seen to be weak, and they don't want to be seen to caving into the other side. So that could make this go down to the wire. And markets don't like that kind of uncertainty. And there is a chance that they screw this up. There is a very real chance of that. So investors need to be cognizant of that. And I think, unlike other times when it was pretty safe to assume that they would get a deal done, while it's unlikely they won't, there's a higher chance that they'll screw it up this time. And so you have to be prepared for that.
And from your opinion, is that, I guess, what you've seen with a lot of these unlikely situations throughout the world, that it's not that they're likely to happen, but they're more likely than we've previously seen in the past?
Yeah, look, that comes back to this idea that risk is increasing, and anytime you have rising risk, then investors get more cautious. And that generally leads to taking positions off the table, leads them parking cash on the sidelines. And right now there's the same kind of rising risk in equity markets, in bond markets, in private equity, in private credit. There are all kinds of risks. We've seen the highest number of companies going bankrupt in the first half of this year that we've seen in a long time, and that's kind of gone unnoticed. And so that there are all kinds of data points that suggest that there is a real reason to be cautious right now. And if the debt ceiling isn't the trigger, then we're going to turn our focus back to a pivot and whether the Fed are going to continue to hike and break things. So there's just this kind of endless conveyor belt of things to not necessarily worry about, but be cautious about and understand that they could have a negative effect on markets.
Yeah, it's a great point. And you mentioned the concentration that we're seeing in the markets, and really that's where most of the performance is coming from. And I think I read a statistic this morning saying that Apple is the market cap is 2.7 trillion, which is more than the whole UK market, and it's more than the whole Russell 2000.
Yeah.
So it's just a crazy thing to think about. So from your perspective, I guess these investors are trying to de-risk and they're going to the stocks that are performing the most, causing more concentration. Is this just a accident waiting to happen?
Well, the other fact that's important to know about Apple is when people talk and they publish data on how much cash S&P 500 companies have on the balance sheet. My friend Steph Pomboy's done some great work on this, and Apple and 4 or 5 other companies between them have like 95% of that cash. Companies aren't cashed up. So people look at Apple, and look, it's not that long ago that we were talking about Apple becoming the first $1 trillion company, and here it is at 2.7 trillion. And that the world where it went from 1 trillion to 2 trillion and beyond was a very different world to the one we have now. We did have zero rates. They're now at 5%. We did have a lot more political stability. We did have an awful lot more things going for us. Money has kind of funneled into Apple as a safe haven. But again, look, Apple has significant exposure to China, and you can see them making moves to sign deals that lessen their dependence upon China, but that's going to take a lot more work to get them away from there. So, on the one hand, you've got tensions with China ratcheting up, and on the other hand, you've got everybody piling into Apple, which is arguably the most China-sensitive US stock there is. So, again, there's just this potential for a misstep here. And with so many people crowding into Apple and Microsoft and Google and these AI stocks, Nvidia recently, anytime you get that kind of concentration, you run the risk that you have 4 or 5 stocks leading the market, and something happens that makes a lot of people want to get out of those stocks at the same time. And because the rest of the market is so weak, it can exacerbate any kind of fall that you ordinarily see. So, again, there are things to think about all over the markets, and that's normally the case. We've had periods in the last few years where it hasn't really been the case. You've been able to just buy things and hold them, and everything's gone up, and that rising tide has kind of floated all boats. Now the breadth is getting much narrower, and so you have to be much more selective. And the more selective you get, the more crowded the trade gets. And again, it's one of those things that if you are in all these stocks and you've been crowded into these small places, and you just assume that the debt ceiling is going to pass by without any problems, I just think that's a risky strategy to take. So, yeah, the data points are there. They're coming out thick and fast as they always do, and social media has amped that up. But there are so many things that could go wrong, and so analyzing which one of those potential missteps has a dramatic effect on your portfolio has never been more important.
Yeah, definitely. I think we've seen the phenomenon in the past few years that these people are very happy to get in very quickly, but at the same time try and get out very quickly. As you said, when there's that news event or when something happens, they want to try and be the first one out the door.
Yeah, no, that's just the way crowds move. Crowds come to these trades slowly at first, and then everyone sees them performing, and the stampede starts. And in the end, they're the only game in town, and that's where we are. And so, with so much confidence put into such a small part of the market, if that confidence turns, we got a very good look at what happens with Silicon Valley Bank, right? That's a confidence issue, and so confidence is such an ephemeral beast. You can't really measure it. I mean, there are attempts to measure consumer sentiment. Inflation expectations is another good confidence indicator, but ultimately it's something you can't get your hands around. And when confidence goes, it goes suddenly, and we get the likes of Silicon Valley Bank, and we see things like that happen, which the solution to was kind of a blanket guarantee on all bank deposits, which is a crazy thing to do, but it was felt to be necessary at the time. So, like I said, we're just in that place where the market's crowded, the risks of a misstep on the policy side are huge, and you need to have a plan for it.
And I guess after SVB, we saw that the Fed, as you said, is quite a blanket sort of policy, but it was they're trying to push their mandate. They're trying to do whatever they can to keep basically the confidence in the system going. So, do you feel like what we could see is something similar to that? It'll be a very short downturn, and the Fed will come up with some idea to try and save things, then it sort of push up again. Or, and I know I've heard you talk about this before, that it doesn't really matter. All we should be focusing on is how we protect our portfolio. So I guess, what's your thoughts on that?
Well, look, you've just described the Fed put, right? You've just described it. Should we just assume that if there's a sharp drop, the Fed will come in and fix it? And that's exactly the mindset that has prevailed for a decade now, and with good reason. And the Fed are now in a sticky spot because they're desperately trying to disavow people of that notion. They're trying to disavow them of the idea that they will just ride to the rescue when things start to crack. So we don't know how Powell and co are going to act once they reach that critical point. I think I've spoken about this in the past. I don't think they want to give back the hard-earned rate gains that they've got under their belts. They don't want to give that 5% back easily. They don't want to go straight back to zero. So what happens? What happens when people talk about the Fed pivot? They assume it's a cut in rates, and rates then go back to zero or head continually in that direction. And so the market's now expecting that because it's got every right to. That's exactly what's happened. So if and when that pivot comes, maybe the pivot is a change in language. Maybe the pivot is we're going to pause. Maybe the pivot is a pause followed by a 25 cut, followed by language that says we're not going to keep cutting. We don't know what the pivot looks like. So to assume this pivot will be like the others, again, it's just a dangerous assumption to make. And I think so many people have been conditioned. This is how the Fed acts. We can be safe in assuming they will continue to act that way. I just don't think that's true, because they've never had inflation keeping them honest on the other side of all the things they've done, and now it's there. And even though it's falling, you look at the true inflation numbers, they're down at 3% odd. Energy prices are still sticky, food prices are still sticky, wage increases are there, and they're very, very sticky. You can't take back wage increases. So there are all kinds of things to suggest that the Fed's work isn't done. And if you look at the confusion in their communication, you can pull up various Fed governors, and they're sending extremely mixed messages. One minute they're trying to sound tough, the next minute they realize potentially the damage that they could do by being tough, and so they're trying to sound a little more dovish, but without being too dovish. And then they're back to talking about how we need to stay vigilant on inflation. There's utter confusion there, and I don't think they know what they're doing, and I don't think they know how this is going to go, and they're kind of on a wing and a prayer at the moment. So, again, if you look at the confidence in central banks, which has largely been the backstop to all these markets for such a long time now, that is definitely evaporating. It's been eroding for a while now, and there is a lot less confidence in the ability of central bankers. You can see it in media reporting. You can see it from commentators. You can see it. You can see it everywhere. You can even see it in some of the parliaments around the world challenging their central banks. So this is a very different world, and people need to understand that. It doesn't mean you can't make money, but it does mean you've got to be cognizant of the risks, because if that Fed put is no longer there, or it's no longer what you thought it used to be, then buying the dip and riding out any downturn in the markets because it's going to go back up again when the Fed comes to rise again, it's just not a strategy for today. It's a strategy for a couple of years ago.
Yeah, it's really interesting. So from your perspective, if we do see, I guess, as you said, the Fed don't really want to give back their interest rate increases. So if we see interest rates remaining this high for this long, I guess, with the current situation in the economy, what would you expect to see?
Look, something's going to break. They will break something, because that's how these things always end. Every rate hike cycle ends with something breaking. And we've seen various crises all around the world in the past when rate hiking cycles have happened. So it's not a question of will they break something, it's a question of what will break, how severe will it be, and what will the response be. And again, it's so important to understand that every time the response has been cut rates, make money cheaper, increase liquidity, they haven't had anything on the other side of that. It's been a one-way ticket. You could do that all you want. Inflation wasn't getting out of control. People weren't out in the streets complaining about the cost of living. They have that now. And so it's likely to be in the bond market. It's likely to be in corporate credit. It could be in the pension system. These unmarked losses, the things that were the cause of Silicon Valley Bank's problems, are littered across just about every bank balance sheet in the country, in America certainly, and probably beyond. So it's most likely going to be a credit-related event, and that's a lot more problematic than a stock market event. If we had a stock market correction in isolation, then given where markets are this close to their all-time highs, it's not such a big deal. But if we have a major credit event, that becomes a lot more problematic because it's much more fundamental to the functioning of the financial system.
And do you think that we will see a point, and I guess going to your point before about how central banks, no one's trusting them anymore. We've already seen that. I think the Bank of Australia and the Bank of England apologizing for not seeing this inflation. But do you see a point where maybe a lot of these decisions are going to go away from sort of the central banks more and monetary policy more to fiscal policy, as we're seeing this, I guess you could say, push the median voters pushing left, and it's focused more on, I guess, this wealth divide and equality for all?
Well, I think central bankers were hoping for a long, long time, and I mean years, that fiscal policymakers were going to come in and do the heavy lifting for them. So it wouldn't be all down to monetary policy. Fiscal policymakers were sitting back going, hey, this is great. We can print money out of thin air and they can lower rates and everything works out. We don't need to do anything. This is great. Well, guess what? You do. And of course, you always had to do. You just didn't think you did at the time because of circumstances. And now here we are. So yes, the likelihood is that there will be more dependence on fiscal policy, but look at the state. I mean, we'll stick the conversation to America for now, but look at the state of the country's finances. Where do you find the room to enact massive fiscal spending bills? It's going to be very, very difficult. They can't get the debt ceiling negotiated. How do you think that's going to go through Congress if they want to start amping up fiscal spending? So, absent another crisis, a real crisis, it's very difficult to see how we get out of this logjam of markets expecting everything to be okay and expecting policymakers to rise to the rescue, fiscal policymakers having no real room to do that, monetary policymakers having their feet held to the flames by inflation. So when you kind of put all that together, it's just a very tenuous picture. And what happens as we go through the debt ceiling is going to be very important, and that's going to happen within a week or two at the most, I would imagine. So we're going to know fairly quickly. But if we do get a hiccup, if these guys do the unthinkable and because of ego screw these negotiations up, then there's a chance it sets off a cascade of all the other places in the market where confidence is fragile, and people think, Christ, if this happens, then we've got to be on the lookout for every bad outcome because we really didn't think there was a chance this could happen. And again, it all feeds back into confidence, and what confidence do people have in markets? What confidence do people have in policymakers, both on the fiscal and monetary side? And that's a huge problem for the markets.
Yeah, it's really interesting. And I guess if that were to be the case, what would you see being the results?
Look, credit events are never good. We don't know what type of credit event it'll be. We don't know where it'll be. But if there's a credit event, credit tends to tighten up dramatically, quickly. We will see defaults. We'll see bankruptcies, and those are at the top of the capital stack and the bottom of the foundation of financial markets. So we'll have another liquidity crisis. You can already see that credit's getting tighter, and these markets function on liquidity. So central banks have been pushing liquidity into markets. They're still trying to talk about quantitative tightening, but overall, as a body, they're pushing liquidity into the markets. Much of that due to the Bank of Japan in recent times, but that again is probably going to come to an end in the not too distant future. So we're back to stage one. We're back to having a financial system that's completely built on the need for not just liquidity, but excess liquidity to make that liquidity cheaper. And that reliance is running smack dab into an inflationary spike, political upheaval, an election cycle, a war in Europe, saber rattling across the Taiwan Strait. There are so many reasons why any one of these things going wrong could ripple through all the other places where people are a little fragile. Now, again, as I've said, markets climb this wall of worry. That's what they always do. But every now and then there's an air pocket. And so avoiding those air pockets is the most important thing. It's okay to buy the dip and be long when you can see that there is ample liquidity and central banks are overtly dovish. And the reason you mentioned the RBA apologized, the reason they apologized was because they basically promised the public that rates wouldn't rise until 2024 at the earliest. The Bank of Canada did the same thing. So if you've got a backdrop where central banks saying we are going to keep rates at zero for the next 2 years, you can borrow money to your heart's content. That's a very different backdrop to the one we have now, where they're all talking tough and all talking about hiking. So the danger of an apology, as we saw from the central banks you mentioned, is that it crystallizes the anger that people have over the cost of living and the tightness of their own personal finances, and it gives them a target. If Phil Lowe hadn't come out in Australia and apologized, people would still have been in the same boat. They'd still have been struggling to make ends meet. They'd still have been seeing mortgage payments triple because of the interest rate rises, but they'd just be screaming at the sky. Now the Royal Bank of Australia have basically come out and said it was our fault. So that gives them a target for their anger. And unfortunately, the target for their anger is the central bank and by extension, the government, because the average man in the street doesn't necessarily view central banks as independent from government, even though they notionally are. It's authority. This is authority's fault. So this is a real tightrope these guys are walking, both the central bankers in trying to tame inflation, meaningfully tame inflation, to make sure if they cut too soon, it doesn't have another outbreak, and policymakers in terms of walking this debt ceiling tightrope. So everywhere you look, there's wires strung up and people inching their way across them, and we're all standing below, hoping nobody falls off. And there's an elevated chance that somebody does, I think.
Yeah, it definitely looks like that's going to be the case. So, you've mentioned that we could see this air pocket, and I guess from your perspective, how do you protect yourself from that air pocket in terms of portfolio?
Well, again, caution. Equities, I think, are too risky right now. Solid corporate credits are a good idea. U.S. Treasuries, bizarrely enough, are a decent idea if you get the right point in the curve for you. We've seen Treasuries rally into debt default things before because they're a flight to safety instrument, even when the thing that is the problem is the issuing authority of those bonds. That's just the way the market's set up. So I'm very wary of growth stocks. I think this tech rally has been impressive, but I don't think it's necessarily real, and it's getting narrower and narrower. As I said, corporate credit, private credit is something that not everybody has access to, obviously, but I think a lot more people are looking at private credit deals because they can assess the credits honestly, and they're not subject to the vagaries of markets and big swings if the underlying business is still okay. So I think a lot more people are looking to have exposure to assets that don't necessarily kind of get caught up in the kind of bipolar mood of markets. It's euphoria 1 minute and depression the next. That volatility, if you can find a way to smooth that out via credits that aren't listed or investments that aren't in the public domain, we've all become used to everything being a stock price and not a business. People don't own businesses anymore. They own stock prices and they rent them. People buy a stock thinking this is going to go up 10, 15%. They don't, generally speaking, buy a business and a share in that business because they like the company's long-term prospects. That's what investing was all about. Trading is very different. And if you're a trader, if you're a good trader, then this is a very good potential environment for you, because there will be a lot of volatility. There'll be a lot of people who've been sucked into markets by these long updrafts who aren't equipped to trade the kind of periods we're going into. So you're going to see exaggerated moves in both directions, which for seasoned traders is going to be a great opportunity to make some real money. So, I think that I've spoken about this so many times. I bore myself with it, to be honest. So apologies for boring anybody else, but understanding who and what you are is job one. Are you a trader? If so, what's your risk tolerance? If you're a trader with a low pain threshold, this is going to be murder for you. If you're a trader with a high pain threshold but good risk management, this could be, like shelling peas this next little period. If you're an investor, it gets a lot more tricky. Right now is a time to be holding cash and looking for opportunities that sprout in good businesses that get wrongly priced due to some kind of market panic, where you can be an investor and you can like the business going forward and want to own a piece of that business. And so pick it up at a level which gives you a much better chance of making money over the long term. So, people say, oh, how do you protect your portfolio? There's 8 million different answers to that question. There isn't a way to protect your portfolio because everyone's portfolio is different. So the awareness of that and the awareness of who you are and what you are, first of all, will give you the clues you need to at least go down the right path towards working out, okay, my risk tolerance is too low. Therefore, I need to lower my risk. My risk tolerance is high. Therefore, I need to be on the alert for things that I can take a swing at. I'm a long-term investor. Therefore, I need cash because there are going to be opportunities for me to pick things up at cheap levels. Knowing thyself, as the saying goes, is step one.
And how do you know if something's worth being worried about? Because I guess that's the issue. If we look at news, there's always so many different.
Well, can it affect your portfolio? Does it have the possibility to affect your portfolio? There's worry and there's worry, right? We should all be worried about plenty of things that don't necessarily affect our portfolio. But in terms of what we're talking about here, the things you should worry about are things that if X happens, it will have a materially adverse impact on my portfolio. If that's the case, and I would say for most people, if the debt ceiling negotiations fail, it will have an adverse effect on your portfolio. So I need to look at that and work out, where do I get hurt and how do I hedge that? So the question of what do I worry about, it's anything that could cause me to lose a lot of money.
Yeah, it's a great message. So if we focus on the US, as you said, there's lots of potential issues going on there. Do you see there being the potential for a soft landing and the potential for everything to be okay moving forward? And I guess if not, what would you think would have to happen? Let's say if you were put in charge of maybe monetary and fiscal, which would be unlikely. What would have to happen for things to be okay moving forward? Is that possible?
Look, there is anyone that says there is 0% chance of this happening in terms of a market scenario is just flat out wrong. Of course, there's a chance of a soft landing. It would be a miracle, and I personally don't see how it happens. The worry for me is that markets seem to be, in many cases, making that their base case. That we're pretty sure that the outlier here is a screw up. We're not going to see a recession. Therefore, we don't have to worry about the effects a recession will have on equity markets. But if we don't have a recession, where does your hope for much lower interest rates come? How do you, is that just a stock market thing? And if it's a stock market thing, does it feed through into the economy? We don't know. So for there to be a soft landing this time around would be the shock of all shocks to me. That's not to say that I give it a 0% probability of happening, because I said that would be foolish, but I handicap it much lower than there being a debt ceiling default, for example. I think there's a higher chance of a debt ceiling default than I do of a Goldilocks scenario. So I will choose to focus on the one that could hurt me rather than the one that, if I'm wrong about it and there is a Goldilocks scenario, happy days, we're off to the races again. I just think if you are sitting back and going, well, they always figure this out and the economic data looks good, so I'm sure they'll navigate all this turbulence flawlessly and we'll have a soft landing. Look, good luck to you. That's all I can say.
Yeah, it seems very unlikely. So, we've talked about so many different topics, so many different things that are currently happening in the world. Is there anything in your opinion that you think isn't given enough attention? Because I guess a lot of what we talked about is quite, widely spread. Is there anything that you don't think is given enough attention in a good way or in a bad way?
Well, it's difficult, right? Because there's so much that demands our attention. So there's an awful lot. And I think everybody right now is not paying enough attention to something, because it's impossible. We all have limited bandwidth. and there are stories happening every day, and a lot of them are kind of small headlines, but they matter. Look at which politicians are visiting which countries. There's meaning, profound meaning in all this. Look at which countries are signing trade deals with each other. Look at what leaders are saying at G7 forums. There are messages being sent, and if they're not overt messages, you can certainly understand the positioning of people by what they're saying. And so I think this argument over de-dollarization is, again, another very important issue to have a handle on. You can pick a side, and I've got people I respect tremendously on both sides of this, which is absolutely fine. For me, the fact that this is something that's important to understand and discuss means it has the potential, one way or the other, to disrupt things. And so working out the difference between the dollar as a reserve currency and the dollar as a reserve asset is a really important thing for people to do, to define those two things and work out why one is more likely to go away before the other. And then what does it mean? And the one problem I have with people on both sides of this argument is everybody is completely dogmatic. It's either the dollar's going to be gone and it's over, this is its last days, or it's the dollar will never go away. And of course, the answer is somewhere in the middle there. The dollar will go away at some point. It may not be in our lifetimes, but the possibility of it being our lifetimes has increased significantly in the last year. Ever since the US Treasury froze Russian central bank assets, the chance of the dollar, and by the dollar I'm talking about treasuries, being the reserve asset, has changed materially. Every central bank in the world is being forced to reconsider a world in which they end up on the wrong side of the United States. And so that has had a significant effect on how much gold central banks have been buying. They bought the most since records began in 1950. So they're doing one thing which you as an investor can pay attention to, regardless of what they say. Central banks are accumulating more gold than they have in 75 years almost. That's a message. It tells you something is happening. So I don't think enough people are focusing on that. I'll get accused by many of banging the gold drum, and that's fine. But I'm on the record as saying I think gold has a place in a portfolio, and that place in the portfolio expands and contracts like everything else in the markets. And right now, the need for gold is certainly expanding on the central bank balance sheets, and I think it's expanding in the average the average investor's portfolio. So that's a place where I definitely think people should be paying attention. The US election cycle, which will begin in earnest before too long, is another one that unfortunately has a very high possibility of increasing the divide between Republicans and Democrats, and by extension, increasing the divide between the population, or among the population, I should say. And sadly, that's not just confined to the US. We see this political polarization on every single issue now. It's a great source of sadness to me that people seem to be incapable of talking about issues they disagree on anymore without it escalating very quickly and it escalating to the point where people become completely intransigent and disregard the other side. And if you think that social media and the rise of AI is going to lessen that anytime soon, I think you're out of your mind. It's only going to get worse. So, it's impossible to keep your eye on everything. And anyone that tries to do that is going to get caught out somewhere, because if you're on top of the headlines, you're not on top of the stories because there's too many headlines. So again, I come back to this idea that there are things that could go wrong that could materially hurt your portfolio. Those are the things to focus on, and focus on properly. Take time to understand the issues, monitor them constantly. There are things in the background that you need to be aware of, and almost subconsciously you'll see drumbeats, and these things that you're tangentially aware of, you'll find being presented more and more in your newsfeed and more in your social media feeds. And that's a sign that, okay, I need to pay more attention to this now because everybody else is paying more attention to it. And once it becomes something that everybody's paying attention to it, my friend Ben Hunt talks about this, the common knowledge game, it becomes more important for you to be aware, not necessarily of what's happening, but what does everybody think is happening? What does everybody think is going to happen? So it's a very, very difficult time to be an investor. And it always is, because investment is not an easy game. But we've had this period where everything's moved to passive, and people have been happy to give up control of their assets to passive managers to save on fees. And I suspect, not that it'll change the flows in the short term, but I suspect that one of the other things you need to do is understand, okay, how are my investments made? If I've got money with this ETF fund or in this pension fund, how are those allocations made? Are they the result of machine learning or automated investments? Or do I have guys making decisions here? And if so, who are those guys? Are they seasoned? Have they been around the last time we had a cycle like this, which is a long shot because it was a long time ago? Or are they, 25-year-old graduates who've been brought out of college and have lived their entire investment careers in the kind of environment that we're just kind of waving goodbye to? There are so many big decisions for people to make. And so boiling it down to a ticker or boiling it down to a generic, how do I protect my portfolio, is such a dangerous thing to do right now. And seeking out that kind of advice is really dangerous for people to do, to go out there and say, I need to find someone to tell me what to do with my portfolio. Unless you're paying that person to individually look at your portfolio and analyze it and tell you where the stress points are and tell you where you could go wrong, then listening to guys like me say, oh, you should do this, you should do that, it's very dangerous right now. It's very dangerous. And so, say if there's one message I can get across to people, it's this: understand who and what you are. And then once you do that honestly, and I've presented about this in the recent past, there is absolutely no shame in looking in the mirror right now today and saying, I did pretty well in the last 5 or 10 years, but I'm not so well equipped for the world we're in now. Right? Because everybody is confused, as my friend Rick Rule said to me, everyone's confused brains with the bull market. And everyone thinks that their portfolios have gone up because they're a genius investor. It's just not true. It isn't true. It may be in a few cases, but in the aggregate, it's not true. Markets have all gone higher, and it was easier to make money than lose it if you've just been investing that way. The world's changed. So look in the mirror and be honest. You're going to see someone staring back at you. Are they equipped to handle volatility coming at them in 4D? The answer is probably not. And so if that's the case, what do I do? And it's not look for stock tips anymore. It's not listen to generic advice about how we should structure our portfolios. The world's getting very, very individual again. We're going back to bottom up instead of top down. And that's in company analysis, that's in portfolio management, that's in our own lives. You can feel it. There is a shift from bottom down to top, from top down to bottom up. It's happening. And the sooner people are aware of that and understand what it means, the better chance they've got of making the kinds of decisions that can prevent them from giving back a lot of the gains they've earned over the last period of time.
And what does that mean?
I sound a bit preachy there, don't I?
Oh, no, that's all right. It was really interesting. But yeah, I guess what does that mean? And I think a lot of us will know from investing, but I guess in terms of other things.
Well, it means, okay, here's an example of the kind of research a lot of people have done over the last several years, right? Read an article on AI, okay? AI is the next big thing. ChatGPT is all over the headlines, blah, blah, blah. How do I invest in AI? Read a second article. NVIDIA supplies all the chips for AI. I'm buying NVIDIA. I know nothing about NVIDIA as a company. I know nothing about its operations. I know nothing about the financial health of the company, its balance sheet. I haven't looked at its results, but they supply the chips for AI. Therefore, they're going to make a lot of money, and therefore I'm going to buy NVIDIA. That's a top-down world. AI quickly down into NVIDIA. And that's why you're seeing all these people herding into NVIDIA. That's exactly why this has happened. Bottom up is, okay, AI is the next big thing. How do I invest in AI? What's the smart thing to do? Okay, first, I'm going to go away and understand the changes that AI makes, both on the hardware side, the software side. what components are needed for AI? Is it simply an arms race? If it's an arms race, who are the 3 or 4 best companies? Is Nvidia now priced egregiously expensive over one of its competitors in the race to supply chips for AI? If so, can I go short Nvidia here and have a hedge on one of these? There are so many things you can do from the bottom up to structure a trade much more effectively than, oh, AI equals chips equals Nvidia. That's worked. Lockdown equals home streaming equals Zoom equals Netflix. That worked for a period. Have you looked at Zoom lately? Right? These things don't last. And so no one bothered to look at Zoom, the company. They looked at the fact that, oh, I'm using Zoom all the time now because I'm home. Therefore, stock's going to go up forever. Guess what? It's down, I don't know where it is now, but it was down 75, 80% at one point. That's the difference between a top-down and a bottom-up world. And top-down works for everybody. Bottom-up works for people who understand the work they have to do and are willing to do that work. And it's not easy. It's not easy. Analyzing companies is not something you can pick up on a YouTube video, sadly, right? It requires what Liam Neeson would call a particular set of skills. And those skills are and have been in decline. So we're going back to that. So again, there are so many big picture questions that people have to ask themselves, and they all start in the mirror. They all start there. And if you can be honest about who you see looking back and their skills and what they're tolerant of and what they can't handle and what stresses them out and what deteriorates their performance, then, and I don't want to just flog a dead horse, but then you can start the follow-on questions from there. And there are lots of them.
Yeah, so many great points. So Grant, thank you so much for your time today. Normally I ask sort of at the end of the interview, what was one message you'd like people to take away? But I'd assume that's probably, you've mentioned it quite a few times. Look in the mirror, look in the mirror.
Yeah, look, I mean, if you want the message, you can lay off the back half of this conversation. I think the first time I said it was about 20 minutes in. You can stop there. There's the message for you.
Yeah, exactly. And we want to hear you do more accents, I think, after Liam Neeson. Northern Irish. Okay, but thank you so much for your time. So, yeah, I guess if anyone want to find out more about your work, I know you've got some podcasts. You're obviously on Twitter as well. Would those be the best places to find you?
Yeah, it's my Twitter handle is @TTMYGH, which is the acronym for things that make you go hum, and everything else you need to know is at grant-williams.com. So that's where you'll find me.
Perfect. I'll put that in the description below. But yeah, thanks again for your time.
All right, mate. Thanks a lot.
Thank you so much for listening, and if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.